global economy, and technology news for today. International Monetary Fund projects stable 3% global growth amid geopolitical and technological crosscurrents. The International Monetary Fund released its July update to the World Economic Outlook, maintaining its forecast for global economic expansion at 3% for the current year. The report highlights that the global economy is functioning under two opposing forces: severe disruptions from ongoing conflicts and a robust investment boom centered around new technologies. United States Federal Reserve signals potential interest rate hikes as persistent inflation reshapes monetary policy. Market expectations have sharply reversed following comments from the new United States Federal Reserve Chairman, Kevin Warsh, as investors now price in potential interest rate increases rather than previously anticipated cuts. Persistent price pressures driven by strong consumer demand and structural shifts in global trade are forcing policymakers to maintain an aggressive stance to restore long-term price stability. Global oil prices average $89 per barrel as Middle East tensions strain energy importers. Crude oil prices have maintained an elevated average of $89 per barrel following the collapse of a brief geopolitical ceasefire framework, heavily penalizing nations dependent on energy imports. The sustained pricing pressure is widening the economic gap between net energy exporting countries and resource-poor, developing nations that are facing mounting import bills. Artificial intelligence hardware exporters lift global technology sector to strong first-quarter gains. Nations integrated into the global technology value chain, particularly major semiconductor and electronics manufacturing hubs like South Korea, recorded massive economic growth surprises in the first half of the year. Increased corporate investment in computing infrastructure has effectively insulated these specific economies from broader global headwinds, pushing their individual growth trajectories well above previous projections. Asian Development Bank lowers economic growth forecast for developing Asia and the Pacific to 4.9%. The Asian Development Bank downgraded its current year economic growth outlook for developing Asian economies by 0.2 percentage points due to persistent supply chain friction. Prolonged volatility in global energy and fertilizer markets has amplified regional inflation forecasts to 4.3%, prompting regional central banks to balance growth incentives against rising consumer costs. Euro area economic momentum stalls with low economic expansion projected for 2026. Economic growth across the euro area is projected to reach just 0.9% this year, reflecting a sizable negative spillover from weak manufacturing performance and depressed consumer confidence. High domestic energy costs continue to act as a significant drag on industrial productivity, offsetting localized fiscal cushioning measures implemented by various European governments. United States personal consumption expenditures price index rises as new tariff pressures loom. The primary inflation gauge favored by American policymakers rose to over 3% on an annual basis, confirming that core inflation remains highly resistant to downward adjustments. Economists warn that a forthcoming implementation of new import duties will likely pass directly through to retail consumers, complicating the timeline for bringing inflation down to the preferred 2% target. Sub-Saharan African economies show divergent growth patterns amid rising global commodity costs. The International Monetary Fund confirmed that overall economic expansion across Sub-Saharan Africa remains stable at 4.3%. Though domestic experiences vary heavily by resource access. While net petroleum exporters like Nigeria are seeing enhanced revenue from elevated global oil benchmarks, non-resource-intensive nations are struggling with severe food security challenges and escalating debt service obligations. Global financial markets brace for extended high interest rates as central banks prioritize price stability. Central banks around the world are abandoning forward guidance mechanisms in favor of strict data-dependent policy maneuvers, indicating that borrowing costs will remain high for a longer duration. This coordinated emphasis on tightening credit conditions aims to anchor medium-term inflation expectations, despite the resulting slowdown in global corporate capital expenditures. Emerging market economies face rising sovereign bond yields and expanding fiscal deficits. Tighter international financial conditions have pushed sovereign bond yields higher, significantly increasing the cost of borrowing for developing countries on the global stage. As international investors reallocate capital toward higher-yielding assets in advanced economies, emerging markets are facing widening fiscal gaps and heightened vulnerability to currency depreciation. Thank you for your attention.